What is IRMAA in Medicare? IRMAA stands for Income-Related Monthly Adjustment Amount. IRMAA is a surcharge that applies to your Medicare Part B and your Medicare Part D premiums. And it applies to people with higher incomes. It's based on an income bracket. So the higher your income, the higher the surcharge will be. Now, the IRMAA calculation uses a very Medicare-specific form of modified adjusted gross income. And to calculate your modified adjusted gross income for IRMAA, you would need your tax return from 2 years ago. Your 2020 tax return applies to 2022. So you want to get your 2020 tax return and find your adjusted gross income, which is on line 11 of your Form 1040. And then to that, you want to add tax-exempt interest that's been earned or accrued, add interest from savings bonds that are used for higher education expenses, add any earned income from living abroad, or add specific forms of income that don't actually show up on your adjusted gross income, such as income from Puerto Rico. There's a list of those. Once you get that total, you compare that income to the IRMAA brackets. If you are filing as a single individual or you're married filing separately and your income is below $91,000, you don't have a surcharge. If you are a married couple filing jointly and your joint income is below $182,000, you do not have a surcharge. But once you're $1 over those amounts, then you have a surcharge. And the surcharge increases as your income goes up. So for a married couple filing jointly, $182,000 is that first threshold, and then the next thresholds are at $228,000, $284,000, $340,000, and $750,000. Now, if you would like to have that chart, you can find this key financial data on my website at www.bestpathadvisors.com. But what can you do then to minimize your IRMAA surcharge over your retirement years? And last week when I talked about Social Security taxation, I covered some things that you can do to minimize taxes, and those same things would apply here. So just to review that again, you can use charitable giving strategies. When you start taking required minimum distributions, you can use qualified charitable distributions. You can use other charitable giving strategies that would fit your situation. You can also use tax-free income from Roth IRAs, Roth 401ks. If you have cash value in life insurance that can come out to you tax-free, you can utilize that. So those distributions can help you control your taxable income over your retirement. It's a good thing to build up assets in Roth IRAs, Roth 401ks, tax-free accounts. Number 3 is you can look at your asset location and be very strategic about where you own the different types of investments that you own. You may have growth stocks. You may have dividend-paying stocks. You may have real estate investments of various sorts. You may have bonds, high-yield bonds, municipal bonds, different types of bonds. So looking at where each of those assets are held to minimize the tax on that investment, but to also minimize the tax that you pay on your Social Security and minimize your IRMAA surcharge. So being very strategic about that. One other thing that applies to this topic would be health savings accounts. So to the extent that you have a health savings account, distributions from that account would be tax-free to reimburse you for qualified medical expenses or in the current year or previous qualified medical expenses. So health savings accounts can also assist with minimizing your IRMAA cost. Those are some things to consider, and I hope that's helpful. If you have some questions or you would like a second opinion on your situation, please feel free to reach out because we are here to help you be on your best path for retirement.